Hi, I'm Sarah Lacy, and welcome to TechCrunch TV. My guest today is Jessica Canning, who's the research director for Dow Jones VentureSource. Jessica, thanks for joining us.
My pleasure.
So we want to talk today specifically about the role that private equity buyouts are playing in providing equity for venture capital deals. Now, I found this interesting in your results for fourth quarter and year-end liquidity you announced yesterday, because in most of my experience covering this industry, buyouts and venture capital are like these two polar ends of the private equity universe that don't usually converge. And it's this year is one of the first times I've seen this really cropping up as the two kind of converging and playing a role with one another. How long has this been going on, and how long have you guys been tracking this?
We've been tracking it for a while, but we just recently started to pick up on the trend and reporting on it. Typically, we've seen between 20 and 30 venture-backed companies get acquired by PE firms over the past 3 or 4 years. But interestingly enough, we actually also did a survey at the end of December polling VCs on what they think would be good liquidity exits. And over half of the VCs that we asked said that they think exits to PE firms through the secondary market and through acquisitions will actually increase next year. So it does look like it's a trend that is building momentum.
That's really interesting. And I think the thing that's important for people to note is we're not talking about just a few deals, and typically these tend to be some of the bigger exits that we're seeing. So in 2010, you guys reported that there was nearly $2 billion in returns. And that compares to $3.4 billion for IPOs. So pretty comparable numbers there.
Yeah, in addition, you also see that PE firms will not only buy out the entire company, but VCs are also getting returns through the secondary market. So 1 or 2 VCs will get their returns while the company remains private. So VCs are able to utilize the private equity market both for total acquisitions and to get their own personal returns.
So you mentioned a couple times secondary markets. I mean, there seems, if nothing else, a clear cultural trend here in what's going on with private equity firms buying out whole companies, and what's going on a share basis with founders doing partial liquidations, with the role secondary markets are playing in some of these bigger companies, allowing them to alleviate the liquidity pressure so they can stay private longer. How are those two trends working together?
Yeah, we're actually seeing it particularly with IT companies. We're seeing a divergent liquidity strategy where typically a company that gets acquired stays private for about 5 to 6 years. But if they try to go public, they're actually holding out for about 10 years and utilizing the buy and build strategy, which is typically with venture capital, it's been through organic growth. But this is kind of an evolving strategy that we're seeing right now with privately held venture-backed companies. Both Facebook and Zynga were part of the top 5 top acquirers for venture-backed companies last year. So you're really starting to see these private companies use the PE strategy for growth in order to go public.
So this is a trend that you guys see as here to stay, it sounds like, based on the polling numbers, which is interesting because some people might look at this and say, well, this is just because the IPO markets haven't been that robust and everyone's expecting 2011 is going to be this great year for tech and clean tech IPOs. But that's not going to replace this trend, it sounds like.
No, definitely not. There's a large backlog of companies that are still private that can't get to the size where they can go public. And this is definitely a good strategy for existing VCs to use in trying to get the returns that they need. Because if a company is private for more than 8 to 10 years, the fund usually only lasts for a 10-year anyway. So they have to get the returns to supplement those companies that can go public.
Mm-hmm. So this is making what's always been a long-term asset class even more of a long-term asset class. Is that a good thing or a bad thing for the industry?
I think it's actually a good thing. I think PE firms can serve as the bridge to extend the life of the company so that they can go public. Whereas a VC really can only hold on to a company for 8 to 10 years, and they have to get some kind of liquidity to return to their limited partners. PE firms can step in and extend that lifeline before the company goes public. So I see it more as an expansion and extension rather than a replacement.
But are VCs going to get the same multiple from a private equity firm buying the company that they would if they held all their shares and waited for an IPO?
It really depends. Not every company is going to be able to go public. And so if that really isn't an option, this can be an excellent option to get those returns rather than just holding out while the company is still private.
And then lastly, who are you seeing as the big private equity firms that are interested in playing this role here? Who are the big names that everyone in the Valley needs to start being aware of?
I think they're all in play right now, especially in the mid-market PE firms. The larger PE firms, they only deal with the multi-billion-dollar companies and straight buyouts. The middle tier PE firms are the ones that the VCs are going to want to approach, because they're the ones that will come in through the secondary market and will be interested in working with companies that have, $20 to $200 million in revenue.
Give us a couple names. It's something our audience isn't particularly familiar with. We're busy building companies, and they're doing good if they know all the angels and VCs.
Yeah, exactly. So you're looking at companies like, BlackRock and Carlyle are always going to be the heavy hitters and are going to be heavily involved.
Okay, great. Well, Jessica, thank you so much, and I'm sure we'll be checking in with you next quarter.
All right, thank you.